In this video, we are going to talk about hedging with futures contracts. So hedging is a form of risk management. So we can use futures contracts and forwards. We can use futures contracts to minimize the uncertainty on future cash flows resulting from an existing portfolio of assets. These assets, of course, can be physical or financial. Now, risk management does not end when you put the hedge on, and there are many, many examples of companies, even countries, that have used hedging and kind of forgotten this point that once you put a hedge on, you still have to manage your position. So sometimes you're left with market risk, sometimes, or almost always, you're left with some sort of counterparty risk, and inevitably, you'll be left with some sort of funding risk. And oddly, you're trying to hedge and protect future cash flows, and often this gives rise to current cash flows that you have to manage. So, to hedge or not to hedge? And this is a really deep question, and one needs to think carefully about it. So companies should focus on their main business and take steps to minimize risks arising from things like interest rates or exchange rates or other market variables. On the other hand, shareholders can make their own decisions. It might increase risk to hedge. So for example, Ashanti was a gold mine in Ghana, and they hedged their production of gold for like 10 years. This was in the 1990s, and they hedged about 10 years of gold production. And this gave rise to them basically going bankrupt because they couldn't manage their position. And finally, explaining to shareholders a loss on the hedge when there's a gain on the underlying is sometimes difficult. So imagine you're running an oil business. You own oil wells. And so you decide to hedge your production. You think oil prices are very high. You're selling oil, so you hedge your oil production against falls in oil prices. So that's great. And if oil prices fall, you'll be the hero. On the other hand, if oil prices rise, you can imagine the following scenario. Let's say your boss, the CEO, doesn't realize you've hedged, and oil prices have gone up, and he comes into your office going, I've just explained to shareholders that we're going to have the best quarter ever because oil prices are so high. And you say to him, well, actually, we're not going to have the best quarter ever because I thought oil prices were going to fall, and if they had, we would have saved a ton of money. And he says, well, while you're packing your boxes, you can think about the ton of money we didn't make because you hedged. Now also, shareholders can make their own decisions. So for example, let's say you're buying a gold mining company, right? You're buying shares in a gold mining company. Are you buying shares in the gold mining company because they're a really good miner and therefore you expect them to do well no matter what the gold price? Or are you buying shares in a gold mining company because you think their price is highly correlated with the price of gold? Now, if it's for the latter reason, you would like their share price to be tightly correlated with the price of gold, and when the price of gold goes up, you would expect their share price to go up, and when the price of gold goes down, you're willing to accept that the share price might go down. You care a lot about whether the company decides to hedge or doesn't hedge. And it's very important, if you are managing a company as you decide what to hedge, transparency with your shareholders, in fact, transparency with your stakeholders, is very important. Okay, considerations you might have to make when you put on a hedge. So, are you hedging exactly what you want? So, if you're buying gold and there's a futures contract on gold, is the gold in the futures contract the same as the gold that you might be purchasing? If it's not, you've got some additional risk. Do you need to worry about your counterpart? If you're working with futures contracts, you have to worry about the CME, but most people don't worry about the CME. But if you're trading over-the-counter forward contracts, then you have to manage that risk as well. Finally, do I need additional cash flows? And we'll see that often the answer is yes. Long and short hedges. A long futures hedge is appropriate when you know you will purchase an asset in the future and want to lock in its price. A short futures hedge is appropriate when you know you want to sell an asset in the future and want to lock in the price. So long, and we'll use this terminology a lot, long means we buy the futures contract. Short means we sell the futures contract. We go long when we want to buy whatever the underlying asset is to the futures contract. We go short when we want to sell it. So, identify which market participant would naturally go long, short, or both. So a corn farmer might use corn futures, right? A corn farmer would naturally go short. Why? Because he is going to have corn and want to sell it, and he would like to lock in that price. A refinery, crude oil futures, okay, a refinery buys crude oil and turns it into other things, gasoline and so on, right? So a refinery wants to be long crude oil futures. A refinery for gas futures or gasoline futures wants to be short gasoline futures. An investor in the equity markets, well, they're an investor. They're naturally long the equity market, so they might want to be short. Or they might want to be long as a mechanism for gaining additional exposure to the equity market. It's not clear. Okay, basis risk. Basis risk is usually defined as the spot price minus the futures price. Basis risk arises because we have uncertainty as to what the spot price of the asset and the futures price of the asset might be when the hedge is closed out. Now, basis is also used in many commodity markets to just mean the difference between different grades or locations and between contract months. So you have a calendar spread or calendar basis. You have a basis between, let's say, crude oil in Cushing, Oklahoma, the WTI benchmark, versus Brent, North Sea. There's a basis there. So that's the difference between two futures prices. But we're going to typically use spot minus futures to be the basis. Now let's say we want to buy an asset in the future. We're going to buy it at time T2, and we're going to use futures to hedge between T1 and T2. We want to buy, so we go long the futures contract. So today, there's an asset price. We could buy it today, but we don't. We're waiting to buy it at time T2. There's a futures contract, and it's trading at F1. So the asset's worth S1, the futures is worth F1. They're different. They don't have to be the same. So we go long futures at time T1, and we wait until time T2, and the markets move. And you hope, and as you can see in this particular example, you hope that the futures price and the asset price are closer to each other. The basis at time T1 is S1 minus F1. The basis at time T2 is S2 minus F2. Now, at time T2, we're going to buy the asset. We're long the futures, so we sell that. So sell the futures, go short to get rid of the position, go short the futures at time T2, and buy the asset. What do we pay? Well, we buy the asset physically in the market, so we pay S2, but we also went long the futures at time T1, short the futures at time T2. So that's S2 is what we have to pay, minus any gains we have. We can offset what we have to pay. So minus F2 minus F1, that's the gain. And so our net price, rearranging our equation a little bit, is F1 plus the basis at time 2. So the futures price at time 1 plus the basis of time 2. Now, what we hope but don't know is at time 1 we hope but don't know that the basis at time 2 is going to be small, at which point we paid F1. So let's do an example. You're going to use futures to hedge the price of an asset you plan to buy. When you go long the futures contract, the futures price is 100 and the asset price is 95. The basis is negative 5. When you exit the hedge, the futures price is 87 and the asset price is 89. What's your effective price for the asset? Well, you pay 89, right? So you're going to pay that. And you've got a gain or a loss in the futures, right? You went long at 100, you went short at 87, you lost $13 on the futures. Well, that's an additional. So basically you paid 89 plus 13 or 102. Alternatively, from the previous formula, it's the futures price at time 1, 100, plus the basis at time 2, asset price minus futures price 2, or 102. Okay, let's do one more example here. You use futures to hedge the price of an asset you plan to buy. When you went long the futures contract, the futures price was 100, the asset price was 95. When you exit the hedge, the futures price is 112 and the asset price is 110. What's your effective prices here? Well, you pay 110 and then you have a gain or loss on your futures contract. You've actually gained 12 because you bought it at 100 and sold it at 112. So your net price was 110 minus 12, 98. Now the formula says you paid 100, the futures price at time 1, plus the basis at time t2, which is negative 2. So 98. So, just to summarize, if we're going to put on a long hedge to purchase an asset using futures contract, we have F1, futures price at the time the hedge was set up, F2, futures price when you're going to buy the asset, S2 is the asset price at the time of purchase, B2 is the basis at the time of purchase, S2 minus F2, and the cost, the net amount paid, is going to be F1 plus basis 2. Futures price at the beginning plus basis at the end. Let's look at short. Let's say we're going to sell an asset at time T2, and we're going to use futures to hedge between T1 and T2. So at time T1, we're going to sell the futures contract. So we're going short the futures at a price of F1. We wait, same thing happens. The basis at time T2, S2 minus F2. We go long the futures to get rid of that position and sell the asset. What do we receive? We sell the asset for S2. We have a gain or loss in the futures contract, F1 minus F2. Net price, S2 plus F1 minus F2, or F1, the futures price at the beginning, plus the basis at the end. Same as before. And we can do the same thing as before. We're going to use futures to hedge the price of an asset we plan to sell. When you go short the futures contract, the futures price was 100 and the asset price was 95. When you exit the hedge, the futures price was 87, the asset price was 89. Futures price at the beginning plus basis at the end, 100 plus plus positive 2, 102. Equally, same example as before. Short the futures contract, futures price is 100, asset price is 95. When you exit the hedge, the futures price was 112, the asset price is 110. Your effective sale price, you sell it for 110, but you've lost $12 on the futures contract. Net, 98. Just to summarize, short hedge for sale of an asset, we are net going to receive futures price plus the basis.